I'd like to focus back here now on these global stock markets. As you pointed out, they seem to be in recovery mode, and some analysts are concerned that this safe haven theme may be temporarily stifled by a renewed appetite for risk. And you've touched on this. I spoke with Jim Rogers, our friend in Singapore, and he agrees with you. He's not selling his gold, and he sees buying opportunities ahead in precious metals. We haven't addressed the silver question. It, of course, is an industrial metal, but it also has a bit of a monetary component. What are your thoughts on this cousin of gold?
Well, I mean, in a recovery such as we have now with risk appetite coming back, I would say that it is likely that silver outperforms gold for a while. But aside from that, I have a preference for gold because it's easier for me to store, and I like physical gold. Having said that, I mean, I'm in Vancouver now, and I've looked at some of the exploration companies. And a lot of things will happen because a lot of the exploration companies have been totally destroyed in terms of their stock performances last year. And if you look at a lot of exploration companies, they're coming off like the CRB from a long base with huge volume on the upside. And so I think that some of the exploration companies may be actually quite interesting.
Just a few weeks ago, Dr. Faber, China shocked the world with its announcement that it would expand its reserves, gold reserves, with a purchase of 454 tons. I think it's a bit ironic that only a week or so before that announcement, the European Central Bank had announced about a 400-ton sale of gold along, I believe, with the Bank of England. What is it that China's central bank sees here?
Well, basically, as you know, the Chinese have very large reserves. I think they're now about $2 trillion. And, I mean, when they look at Mr. Bernanke, they have to see the same that I see. They don't want to do business with him. They have these reserves in dollars mostly, and they can't get rid of them without destroying the market, so they would harm themselves. With new money, for the sake of diversification, they are acquiring resources, and not just gold, but also copper and the concessions in Africa and in Latin America and so forth and so on. I mean, for the Chinese, resources is a geopolitical top priority because they are resource poor in copper, in oil, in iron ore, and in food. So basically, they will buy hard assets, and they don't trust the dollar entirely any longer, and rightly so. Now, it is not shocking that they acquired 400 or so tons of gold for the simple reason that they'd be very stupid if they would make an announcement before they go and buy something. Then you have all the hedge funds front-running them. So, of course, they acquire assets quietly.
And that would explain the sharp movement or advance in gold as soon as the market was made aware of the event.
All Asian central banks, they have practically no gold in their reserves. They have maybe 1 to maximum 2% of their reserves in gold. And if, say, the IMF sells its gold, the Asians would probably take it up very quickly, also Middle Eastern investors. I mean, I'm not worried about the IMF sales and central banks selling in Europe. I think each time the IMF and central banks in Europe sell something, it's a buy signal. Because you remember in
Exactly.
1999, the Bank of England sold its gold at less than $300. The Swiss sold their gold at less than $300. If they had just kept it, they would have made much more money than anything else.
Let's not forget the Bank of England's brilliant sale of its gold at $250 and change.
That's why, you know, the central banks, you shouldn't have a high regard for them. They're all brain damaged.
That's true, but I do have to give a hat tip to China's central bank, which apparently they've read Sun Tzu's The Art of War, because I think the general would be quite impressed.
They could have bought gold when it was around $300, and we actually advised them at that time to do so.
But at least they're striking like a lightning bolt here and not telegraphing their intentions in advance. So I think Sun Tzu would be impressed. The prices for basic goods and services continue to climb despite talk of deflation. And after this credit crisis passes fully, some folks are arguing that Argentina-style hyperinflation could unfold, while others point to post-World War I Weimar Germany. At the end of the day, Won't these bailouts and quantitative easing moves lead to runaway inflation?
I would not rule it out for the simple reason that once the government debt is very large and growing in the U.S. as a result of the household deficits by the government, the fiscal deficits, and the Fed has all these bonds in its balance sheet, as interest rates would say, the market rates would have an upward bias and the bond market, the government bond market breaks, the temptation will be to keep interest rates artificially low. In other words, below the rate of inflation. I'd just like to highlight another economist, Harvard, Mankiff, who recently wrote a piece in the Wall Street Journal and suggested that you should actually tax savings away. In other words, create negative interest rates. Say you have a $100 deposit today. In a year's time, it should be taxed at, say, 3%. So you expropriate it, and that forces you to... I mean, the ideas with which some economists come up is just mind-boggling. He calculates that today interest rates should be at -5% to stimulate the economy. But that frame of mind is exactly what is going through the heads of the Fed officials. And so when you get inflationary pressures, and don't forget, we have already today some inflationary pressures. In New York, the subway fares went up by 20% recently. And there are lots of things that go up in price. But anyway, the Federal Reserve, in my opinion, will keep interest rates for a long time to come below the rate of inflation, and that then risks to lead to very high inflation rate. I mean, the whole system is bankrupt without it creating inflation. They don't have the money to pay the unfunded liabilities arising from Medicare and from the deficits and from the Social Security and so forth and so on. They'll print money, and I think the outcome will more likely be high inflation rates than deflation.
All they're doing is keeping the game of musical chairs going for now.
Yes, postponing the true solution.
Very good. You know, the trillions of dollars of mortgage-backed securities and property values, that adds weight to rumors of even more trouble ahead. However, don't you think that the Fed and the global central banks, well, they're just filling the other side of the balance sheet, everything from TARP? Ultimately, where does this lead us?
It essentially leads to a worsening balance sheet of the government. The government in the U.S. still enjoys some kind of a AAA rating, but I don't think it deserves a AAA rating, certainly not looking forward. So my view is the private sector, yes, there will be more losses. The worse the economic situation is, the more losses there are, the more the government will essentially lend money to the banks free of charge to see them through. Now, economically, this will again create unintended consequences. I mean, why should a secured bondholder of GM or Chrysler get paid only 10 cents to the dollar, whereas a bondholder of a bank gets fully paid? I don't see the rational. But, you know, we have interventionist policies. And don't forget Mr. Obama. As you know, Illinois politics is something else. So I think it planned economy, a command economy,